Okay, so let's unpack this. Imagine operating in the shadows for decades.
Right.
You're this private giant basically running the entire back end of the American healthcare system, but you don't have to tell anyone anything.
No quarterly reports, no analysts breathing down your neck.
Exactly. And then you decide to flip the switch, you go public. And today, right now, we are looking at the very first report card for that transition.
It is a massive moment we're talking for. It's about Medline. And honestly, the scale of what we're looking at today, it's enough to make your head spin.
It really is. And for anyone who hasn't checked their calendar, it's Thursday, February 26, 2026. Medline just dropped their Q4 2025 earnings report, their absolute debut as a public company.
Yeah.
And we are doing a deep dive into this today because looking at the market reaction this morning, it is messy.
Oh, it's very messy.
The stock is moving. People are arguing on the networks. Our mission today is to look at this earnings report, the press release, and the earnings call transcript with CEO Jim Boyle and CFO Mike Drazen, and really figure out what is actually happening under the hood.
And it's messy because it's complicated. I mean, if you just look at the headlines, you see a revenue beat but an earnings miss.
Right.
But if you stop there, you are missing the entire story. This isn't just about whether they sold enough surgical gloves last quarter. This is about a fundamental shift in how hospitals operate today. Boyle kept calling it a crisis of complexity.
Crisis of complexity. It sounds dramatic, sort of like a movie title. But before we get into the crisis part, let's just ground ourselves in the actual numbers, because this is the first time we've really seen the books wide open. Just how big is this beast?
It's gargantuan. Let's look at the top line first. Just for the fourth quarter alone, Medline pulled in $7.79 billion in revenue.
Which was higher than Wall Street expected, right?
Significantly higher. The consensus was looking for about $7.52 billion. So they beat that by over $260 million. And if you zoom out to the full year of 2025, they hit $28.4 billion in sales. That's up 12% year over year.
12%. I mean, double-digit growth for a logistics company seems pretty wild. Usually you only see that kind of growth in tech, not in moving boxes of bandages around.
Exactly. In a mature market like healthcare distribution, 12% is a total outlier. It tells you they are aggressively taking market share from someone else. But, and here's where that messy part comes in, they missed on earnings per share, the EPS.
Right, the bottom line. So the analysts were expecting a profit of 24 cents a share, and Medline posted, what, -1 cent?
-1 cent. But
Okay, so hang on. You're telling me they sold $28 billion worth of stuff and lost money? Because that sounds like an absolute disaster for a debut earnings call. Why isn't the stock just totally cratering?
because you have to read the footnotes. This is where the whole IPO context is everything. Remember, they just went public back in December. They raised over $7 billion. Right. That is a fortress of cash. The loss you see on paper is largely due to the one-time costs of going public, and crucially, what they actually did with that cash immediately after the bell rang.
Which was paying off the credit card, essentially.
Aggressively paying it off. They took $4 billion of that IPO money and immediately paid down their debt. And this is the metric that really matters for them right now, net leverage. Before the IPO, their leverage ratio was 4.9 times.
Which is high. That's getting into risky territory for a company that size.
It is very high. It means if interest rates spike or the economy tanks, you're in a lot of trouble. But by paying down that debt, they dropped that ratio all the way down to 3.1 times.
Wow. So why does that specific drop from 4.9 to 3.1? Why does that matter to the listener? Why should we care about Medline's leverage ratios?
Because it buys them freedom. When your leverage is high, you essentially work for the bank. Every dollar goes to servicing debt. When it's low, you work for yourself. By dropping that debt, they freed up massive cash flow. In fact, they're now sitting on a war chest of about $1.9 billion in cash, and they generated $1.3 billion in free cash flow for the year.
So the loss of 1 cent per share is basically just accounting noise. The reality is they are sitting on a mountain of cash.
Precisely. CFO Mike Drazen was very clear about this on the call. This is not a company struggling to keep the lights on. This is a company that just cleared the decks so they can go on the offensive.
Okay, so they have the money. Now let's talk about where they are spending it. You mentioned this crisis of complexity earlier. CEO Jim Boyle spent a lot of time on the call talking about this. What is actually happening in hospitals right now that's so terrible?
It's a perfect storm.
Yeah.
If you are running a hospital in 2026, you're getting squeezed from every conceivable side. You have cuts to Medicaid and Medicare reimbursements. You have massive regulatory uncertainty. I mean, we've got the one big beautiful bill creating chaos at the federal level, plus the lingering legacy regulations of the ACA.
Right.
And on top of all that, labor is still incredibly expensive and really hard to find.
So hospitals are broke, they're understaffed, and they're confused by new laws.
And they're highly inefficient.
Yeah.
Boyle told a story on the call that I think perfectly encapsulates the opportunity for Medline here. He talked about a massive, large, faith-based integrated delivery network, an IDN.
And for anyone who doesn't know, an IDN is basically a massive hospital system that owns everything in a specific region. The hospitals, the clinics, everything.
Right. And before Medline stepped in, this specific system was using 5 different distributors.
5.
5. Just think about the logistics of that for a second.
That's 5 different trucks backing up to the loading dock every day, 5 different sales reps calling the purchasing manager, 5 different invoices to process.
It's an administrative nightmare. It's bloat. And in a world where margins are razor thin, a hospital just can't afford that overhead anymore. So this IDN fired the other 4 and consolidated everything with Medline.
Wow. And that one deal was part of, what, a $2.4 billion year for new signings?
That's right, $2.4 billion in new business in 2025 alone. And the reason they can win those massive consolidated deals is because of this concept they call the continuum of care.
Yeah, we hear that buzzword a lot in these reports. What does it actually mean practically for a supply chain company?
It means you don't just serve the big hospital building. Most distributors stay in their lane. You have guys who only do acute care, the trauma centers, the ERs, the big surgical suites. Then you have entirely different companies that do non-acute, so your nursing homes, your physician offices, independent labs.
Okay.
Medline is unique because they dominate both sides of that coin.
So if I'm a hospital CEO and I'm buying up nursing homes and urgent care clinics to expand my regional network, I don't want to deal with a new vendor for every single new building I buy.
Exactly. You want one throat to choke, as they say. You want one truck that drops off a pallet of gowns at the main hospital, and then that same truck drives down the street to drop off a single box of gloves at your new outpatient clinic.
Mm.
Medline's the only player who can promise that across the entire board.
Which sounds incredibly efficient for the hospital. But for Medline, that sounds like a logistical headache. If you're consolidating all that volume from all these competitors, you have to actually put it somewhere. And this brings us to the part of the report that I really want to dig into. The robots.
Ah, yes, the empire of shells, as I like to call it. Medline currently operates 29 million square feet of warehouse space in the U.S. alone.
29 million square feet. I can't even visualize that.
It's roughly 500 professional football fields of medical supplies. But here's the structural problem they are facing. Building new warehouses right now is incredibly expensive. Land costs are up. Construction costs are through the roof.
Right.
So Jim Boyle posed this challenge to his operations team. He basically said, how do we make our existing 29 million square feet operate like 32 million square feet?
So how do you expand without pouring a single drop of new concrete?
Exactly. And the answer wasn't magic. It was density.
Yeah.
And to get that level of density, you need robots. But they aren't just using one type of robot. They're using 2 very specific, very different technologies.
Let's break those down because the distinction between them is actually really fascinating. First, you have AutoStore.
Right. So AutoStore is for the small stuff, what they call less than case picking. Imagine you were a small rural clinic. You don't need a massive pallet of 5,000 bandages. You just need 3 boxes.
Okay, makes sense.
In the old days, a human worker had to walk down a very long aisle, find the right shelf, pick 3 boxes, and walk all the way back to the packing station. It's slow, and more importantly, it wastes a ton of space because you need wide, empty aisles for people and carts to move through.
And AutoStore fixes that how?
It entirely eliminates the aisle. It's basically a giant, dense cube. The inventory is stacked in individual bins, very deep inside a metal grid, and these little robots, right on top of the grid, dig out the exact pin you need and bring it to a human stationed at the edge. They have this system in 19 facilities now, running over 2,100 robots.
So it's goods to person.
Exactly. It packs the inventory down so tight that you save massive amounts of floor space.
Okay, so that handles the small stuff. But hospitals buy big stuff too. Pallets of 5A saline, massive cases of surgical gowns. You can't put a wooden pallet in a little plastic bin.
No, you can't. And that is where their partnership with Symbotic comes in. This is a new pilot program they're running in Columbus, Ohio. And what's interesting is Medline is actually Symbotic's very first customer in the healthcare vertical.
So how is Symbotic different from AutoStore?
If AutoStore is like little ants working on a grid, Symbotic is like AI-powered Tetris. It deals with the bulk cases. The AI system looks at the inbound pallets and figures out how to break them down, stack them, and store them in a way that is far denser and far higher than a human on a forklift could ever safely manage.
So by packing the physical warehouse tighter using AI spatial awareness, they create phantom capacity.
That's a great way to put it. They get that extra 3 million square feet of capacity, essentially, for free, well, for the cost of the robots, rather than buying new land and building new roofs. It's a massive capital efficiency play.
And on top of the physical robots moving boxes around, they also talked about this software partnership called Empower with Microsoft. It sounds like a Marvel superhero team-up.
It sort of is, if you're a supply chain manager. It's what they call a control tower. And it addresses the panic factor in healthcare. Because supply chains break constantly. Ships get stuck in canals, overseas factories shut down. Usually the hospital only finds out there's a problem when they go to order the item and the computer says it won't show up.
Which is way too late if you have surgery scheduled.
Empower uses Microsoft's AI to predict those disruptions weeks or even months in advance. It monitors global data and says, hey, you're going to run out of surgical drapes in 3 weeks because of a massive storm in Southeast Asia. But here is an approved substitute product that is in stock in a local warehouse right now. Do you want to switch?
So it solves the problem before the surgeon is actually standing in the OR with nothing to wear.
Exactly. It moves the whole system from reactive to proactive.
Okay, so they clearly have the tech side locked down. The efficiency is there. But we have to pivot to the absolute elephant in the room from this earnings call. The thing that is eating up a huge chunk of their potential profit right now, tariffs.
Yeah. The $490 million headline.
It is a staggering number to just casually drop on a call. They said tariffs hit them for $290 million in 2025, heavily weighted in the back half of the year. But they project a $490 million net impact in 2026. I mean, that's almost $500 million essentially evaporating.
And the timing of this earnings call was wild because just the day before Wednesday the 25th, the Supreme Court handed down that major decision regarding IEPA.
Right, which is what allowed the new Section 122 tariffs to go through, that 10% tariff across the board. Again, we are just impartially reporting the facts of the legal changes here, but the business impact is massive.
Right. And I think a lot of people, average investors, they assume, okay, it's a 10% tax on imported goods. Just raise your prices 10% and pass it on to the hospital. But the call revealed it is not nearly that simple because of a dynamic called inventory lag.
Walk us through that, because I think this concept confuses a lot of people who don't work in global logistics. Why can't Medline just raise the price of a glove today?
Because Medline's whole value proposition is acting as a safety net. They hold huge amounts of inventory on hand, usually 3 to 5 months worth, so that hospitals never run out, even if a port closes.
Okay.
That means the physical gloves they are selling to a hospital today were actually purchased by Medline 4 months ago at the old pre-tariff price.
Right.
But the new gloves arriving at the Port of Los Angeles today are getting hit with that new 10% tariff. Medline has to write the check to the government today to get those goods off the boat. But that expensive glove then sits in their warehouse for 4 months. So the cost doesn't actually hit their profit and loss statement until that specific item is sold, say, in June or July.
So there's this massive timing mismatch. The cash goes out the door right now, but the expense shows up on the books months later.
Correct. And so the big question from all the analysts on the call was, are you going to pass this new cost on to the hospitals once that inventory cycles through?
And the answer was genuinely surprising. I fully expected them to just say, yes, absolutely, we are protecting our margins.
Instead, Jim Boyle used a very specific, deliberate phrase. He said, we are in the boat with our customers.
In the boat, it sounds nice, very partnership-oriented, but isn't that just a nice corporate way of saying we are going to willingly lose money?
It is a strategic loss. They did do one price increase back in August 2025, but they are terrified of doing it again because they know hospitals are at a financial breaking point. If Medline raises prices another 10%, a hospital might literally go under, or they might aggressively look for a cheaper vendor.
So Medline just eats the $490 million.
They eat a significant portion of it. And this brings us right back to that IPO war chest we talked about at the beginning. Because they have $1.9 billion in cash, they can afford to eat it. A smaller regional competitor, one who is leveraged to the hilt and doesn't have that cash cushion, they cannot do that. They absolutely have to raise prices to survive.
Which makes them totally uncompetitive against Medline. So Medline is basically using its balance sheet as a weapon.
It's predatory in the smartest possible way. They use the hostile tariff environment to essentially starve out the competition. They win the market share right now by keeping their prices stable, and they worry about rebuilding the profit margin later once they own the entire market.
That is a ruthless long game. But let's look at what they're actually selling to grow that market share, regardless of price. They highlighted two specific growth areas in the report: kitting and labs. Now, kitting, I mean, it sounds like something my grandmother does with yarn. What exactly is kitting in a healthcare context?
No yarn involved, thankfully. Think of it like a meal kit service, like HelloFresh, but for open heart surgery.
Okay, that definitely puts an image in my head.
If you are a surgical nurse setting up for a complex procedure, traditionally you have to run around a massive supply room, pulling 50 different individual items. A specific scalpel, a specific suture, a specific drape, a sponge count system. It takes a ton of time, and if you accidentally grab the wrong size of something, it's a huge problem during the surgery.
And nurses are already overworked and burnt out. The labor shortage is real.
Right. So Medline's kitting business puts all 50 of those items into one sterile, pre-packaged tray, customized for that specific surgeon's exact preferences. The nurse opens one single box, and it's all there, ready to go.
So they aren't just selling the physical supplies, they're selling the labor savings.
They're selling time. And in a labor shortage, time is the single most expensive commodity a hospital has. That is why their kitting segment saw such outsized growth in 2025. It solves a profound labor problem, not just a supply problem.
Then there's the other growth area they mentioned, labs and diagnostics.
Which is a $25 billion total addressable market. And Medline is currently only doing about $1 billion in that space. This is their absolute next frontier. It fits that continuum of care strategy perfectly.
Because they're already in the building.
Exactly. If they can convince the hospital system, hey, we already bring the truck to the surgery center every Tuesday, just let us bring the test tubes and the chemical reagents for your lab on that same truck. It's an incredibly easy sell.
It seems highly logical. But speaking of where all these things are made, there was a moment in the Q&A portion of the call where Boyle got really real about the whole Made in America debate. Obviously, there is all this political pressure right now for domestic manufacturing of PPE. We want security. We don't want to rely on foreign supply chains in a crisis.
Ideally, yes. I think everyone wants that baseline security. But Boyle essentially threw some cold water on the economic reality of that shift. He flatly stated that the cost difference to manufacture domestically is 3x to 7x.
3 to 7 times more expensive.
Yes. A standard surgical mask made in a facility in Georgia costs up to 7 times more to produce than that exact same mask made in Asia. Boyle was very clear about the math. Unless the government writes a massive check to subsidize that cost difference, or strictly guarantees they will buy the volume regardless of the price, mass domestic production just isn't economically viable yet.
Because the hospitals are already broke, they can't afford a 700% markup on daily consumables just for patriotism.
Exactly. So despite the heavy tariffs, despite the political rhetoric from both sides of the aisle, the supply chain for healthcare is going to remain highly global for the foreseeable future. It has to, just for the math to work.
So let's look forward then. It is early 2026. What is the outlook they gave the street?
Cautious optimism, I would say. They are projecting organic sales growth of 8 to 9%, and they expect adjusted EBITDA, which is basically their operating cash flow, to come in between $3.5 and $3.6 billion for the year.
But they did wave a bit of a yellow flag on the call about utilization, didn't they?
Yeah, they did. This is the flip side of those government cuts we talked about. If Medicaid pays less or out-of-pocket costs rise, fewer people go to the doctor for routine things, or elective procedures get delayed. So Medline expects the actual physical volume of healthcare being performed in the U.S. to slow down slightly.
But wait, they think they can still grow 9% in a market that is physically shrinking?
By stealing share. That is the whole strategy right now. The total pie might get a little smaller, but Medline's slice gets significantly bigger. And remember, they have that post-IPO M&A cash just sitting there ready to go.
And they specifically mentioned they're actively looking to buy what they called non-core assets from their competitors. This feels like another one man's trash is another man's treasure situation.
It absolutely is. Just look at what they bought recently. They acquired Convatec's skincare line. They bought Microtech surgical drapes. These are boring, steady, unsexy businesses that high-tech medical device companies just don't want to deal with anymore.
Because those tech companies want to focus on the flashy stuff, right? Like AI heart valves and surgical robots.
Exactly. They want high-margin, high-tech. Medline looks at that and says, fine, we will take the basic surgical drapes off your hands. We already have the delivery trucks going to the hospitals anyway.
It just feeds the beast. It constantly increases the density of products on that one truck.
It's pure logistics math. If the truck is driving to the hospital regardless, adding another box of drapes to the back is almost pure profit margin.
So let's pull all this together for the listener. We have a company that has just aggressively cleaned up its debt profile, is using cutting-edge AI robots to densify its massive warehouses without building new ones, and is using its deep cash reserves to absorb massive tariff costs that would absolutely kill a smaller competitor.
That is the summary of the report right there. Medline is clearly positioning itself not just as a vendor you buy gloves from, but as the inevitable underlying infrastructure of healthcare.
It feels like we are literally watching the Amazonification of the hospital supply chain in real time.
I think that's a very fair comparison. But you have to remember the stakes here are vastly higher. If Amazon misses a package delivery, you don't get your new toaster on time. If Medline misses a delivery, a scheduled open heart surgery gets canceled.
Right. So as we wrap up this deep dive, what is the one provocative thought you want the listener to walk away with today? Something they can chew on that goes beyond just the earnings numbers.
I keep thinking about this winner-take-all dynamic we're seeing unfold. Medline is essentially betting that the baseline cost of doing business in healthcare today, buying the advanced robots, building the AI control towers with Microsoft, absorbing $500 million in tariffs, that cost is becoming so astronomically high that only the absolute giants can survive it.
The competitive moat is just getting incredibly wide.
Wide and deep. I mean, if you are a mid-sized regional distributor right now, how do you possibly compete with a company that makes 29 million square feet act like 32 million? We might be looking at a future very soon where the healthcare supply chain isn't a competitive free market anymore, but rather a utility run by one or maybe two massive, impenetrable players.
Because scale is essentially their only defense against regulation and complexity. And Medline just gave everyone the first public look at their blueprint for building that monopoly.
They certainly did.
Yeah.
And right now, look at this balance sheet. They are the ones holding all the cards.
Fascinating stuff. It turns out the back-end logistics of healthcare is a lot more interesting and, frankly, a lot more ruthless than just moving boxes of bandages. Thank you for breaking it down with us today.
Always a pleasure to be here.
And thank you for listening to this deep dive. We'll see you next time.